Steve Jobs famously said, ideas without action are not ideas, they are regrets. Hello and welcome to another edition of Wizards of the Street. I'm Ramesh Tamani. My guest started his career as an engineer and then switched midstream to equities. So how does a boy from small town Aurangabad take on the big boys and the Ivy League culture of Dalal Street? We will find out. But my guest today not only manages multiple schemes and over 35,000 crores in assets, he is also an award-winning fund manager. Please help me welcome the head of equities at Canara Robeco AMC, Shridatta Bhandwaldar. Shridatta, welcome to our show.
Thanks a lot. Thanks, Ramesh, for having us here.
Shridatta, I mentioned in the introduction that you're an engineer by training. What prompted you to get into equities? I'm very curious.
So, of course, the first decision was more by elimination. So, as I spent 3 years doing mechanical engineering, I realized that probably my heart doesn't lie in the technical part of it, and I want to play a larger canvas. That's where I actually decided to pursue the business administration. That's how I actually got hinged into equities for the first time, because as I came for my MBA in Bombay, you got exposed to the financial markets, the economics, how economy functions, and I was an avid reader. And reading is something that actually goes beyond geographies, and so in a way you get to explore the world in a faster way than where you are. And that's when actually first I got actually interested in equities. That's where my journey towards equities started actually.
But still, you know, boy from Aurangabad, you had a job in engineering, you could have found another job. What did the family say when you moved into equities?
My family has always been supportive, thankfully. The father, I'm very, very proud of my father. He has always been a person who has kind of gone beyond the small town thinking. He was open to actually me doing whatever I want, and he was in full support for me to explore something that typically people don't tend to do with my kind of background.
Just to pursue the point a bit more, does your father now ask you for financial advice? Do your brothers ask you, do they have demat accounts?
No, in fact, I think except my younger brother, nobody has even demat account in my family. So
right.
Largely they are not keenly following what I'm doing or what happens here in equity markets. So it's a kind of, in a way, a parallel world out there in a way.
Yeah,
as far as family is concerned.
Given your performance, I think they might live to regret that, but we'll talk about that later. Shridatta, let me ask you a question. When you studied engineering and then you read a lot, so I'm sure you read about Charlie Munger, and Charlie Munger talks about interdisciplinary investing. You learn from engineering, learn from psychology, learn from medical fields, checklist in medical fields. What has been your learning from engineering that you applied to the equity markets?
Sure, I think twofold. When I think about it, as you are asking, engineering is actually using the basic scientific principles to convert the basic scientific principles into a manufactured product in a way. When so there is a process to everything, and that process has to be followed to the T. And I think that's one thing, as I look back, that I picked up there, that you can't have process deviations if you want the same similar kind of outcome based on your input. Yeah, so there has to be a methodology. So if there is a X as an input and Y as the outcome, so X is the input which you have to follow it to the T. You can't have X plus 0, X plus 1 or X plus 2 and expect Y as an outcome. So your process has to be followed.
Understood, Shridatta, but let me ask you a question. I mean, you're talking like an engineer would talk, and I would imagine, but markets are psychologically driven. I mean, they go to extremes, as you know, in every bull market, and extremes of pessimism in every bear markets. And yet, as a fund manager, you run public money. So how do you deal with the psychology of the markets?
So you're right. The market is a kind of two-part thing. One is the science or process part of it. Second is psychology part of which, as you alluded to. That, of course, you picked up as you actually got that experience and you started managing money, or you are an analyst. As you gain that experience over the last 15, 17 years, I have actually learned the second part. But the first part is equally critical, because that keeps you sane most of the time when people are actually losing their saneness, because you know, if, for example, if you know that fundamentally any business's valuation or value is intrinsically dependent on the discounted cash flows over a period of time,
The earnings.
or the earnings or discounted cash flows, if there is a significant deviation that you know that the market is not following the process, it gives you at least that starting point where you can actually go to the second bucket and start thinking that am I being rational or irrational in ascribing the valuations that I'm ascribing. So
Fair enough, but let me get back to the point to you, because let's say during COVID, right? Psychologically, you're scared to be in the markets, and yet, things were cheap. How did you deal with that situation?
of course, COVID was once in a 100-year event, and to that effect, it was significantly different than just using a process. But I think there you go back to the behavioral part, or the psychology part, or the rationality or irrationality part of market, which over a period of time, when I have been market for last 17 years, that's when you learn that part, second part. That, of course, engineering doesn't train you for that.
Engineering doesn't teach you that.
Teach you that.
Good enough.
That you have to learn out of experience.
But one thing you've learned, and you mentioned many times in your interviews, is that you have an aversion to cyclical business. You don't like cyclical businesses. Why is that?
It's not that I have aversion to cyclical businesses, because fundamentally all businesses are cyclical. The cycles are, of course, the intensity of cycles is different. Some are deep cyclical, some are narrow cyclicals. So you will have cyclicality in the earnings, or to some degree balance sheets also in most of the businesses. What I'm careful about is businesses where the cyclicalities could be deep, and the cash flows can be uncertain. And typically, these businesses over a period of time, if you study those sectors, you realize that okay, they tend to leverage themselves up on the wrong side of the cycle. So that's where you have to be careful about. Otherwise, if it's a cyclical,
So basically infrastructure type of businesses.
Infrastructure kind of businesses or commodity kind of businesses.
And what are the good businesses on the other end?
Good businesses are clearly all the businesses which have those basic traits of capital efficiency, and homogeneity or structuralness in earnings. Although they also have cycles, but those cycles are far moderate cycles. So it is FMCG, it is largely the entire consumption space. In India, I think even banking is little more structural than cyclical. Probably eventually we'll also get there, but as of now, insurance companies are again structural. IT, while it is global, called as global cyclical, but the cycles are very moderate typically.
In India, the demand is pretty robust
demand is
out there.
pretty robust, so-
But to come back to a point, Shridatta, I mean, if you talk about avoiding cyclical businesses, do you feel that you can pay any price for these non-cyclical businesses?
No, you have to be careful about on both sides. As I said, basically, even in cyclicals, we are just careful. We are not completely avoiding them. We are careful about when we want to participate, when we don't want to participate in them. Whereas when you go to the other side, which is what you are referring to, the expensive businesses which are structural in nature, their ROE, ROCs are extremely of good nature. So naturally they are expensive. They will always be expensive than the rest of the market. But you have to be careful about their incremental capital efficiency and incremental earnings growth. So when it comes to the expensive part of the market, we are very, very sure that we want to be focused on incremental earnings growth. For example, without giving out the name, there is a large retailer in India. It is very expensive, but can it continue to deliver 30% earnings growth for a long period? Or that 30% itself is moderating. If that 30% starts moderating, which is expectation or built up in the valuation, then it is a challenge. So again, on that side, we are careful about differentiating between businesses which are expensive, but where the earnings are trending, getting upgraded or going to trend up and going to sustain for a longer period, and the businesses where the earnings are likely to get downgraded and the longevity might have been compromised or the thesis might have changed. So you have to differentiate, I think, on both sides. So
another thing everyone tells me, Shridatta, including you, that management quality is so important. How do you test for management quality? I mean, all management speak a good book and promote their companies, What are your tests?
So I think that the fundamental tests remain the same. You have to test the management on ability and intent. So when you say that some management is above average and some management is below average, when you define management as above average, clearly you have to first test it on ability. And to test the ability, it is very simple to go back and see what they have done in the past, right from how their business's growth rate has been vis-a-vis the industry.
So history.
History. So historical data points tend to tell you a lot more about the ability, except IPOs of course, than anything else. So that's one. There you get the ability gets tested. Second is intent, and that becomes probably that is even more critical, because there could be businesses where effectively the businesses are generating cash flows, but the capital allocation or accounting policies or aspects like that are not in place. Corporate governance is not in place. So you being minority shareholder is actually not beneficiary of the cash flows that company is generating. Yeah. So those are the two, I think, tenets on which you have to test. The details could be a lot more within both these buckets. Like in ability, you can actually go back and test their, check their accounting practices, who their auditors were, how their board construction is, related party transactions, how their past capital allocation strategies have been. So ability, testing abilities is fact-based. Intent, of course, again you have some facts, and some you have to make a judgment. Yeah.
But Warren Buffett made a judgment. He said that between a great business and a great management team, the business would win every time. What is important to you, being invested in a great business or a great manager?
I think great business any day. Of course, it's not black and white, but given binary choice, it should be the business, because typically the underlying traits of businesses define how eventually those businesses will end up doing, rather than just traits of management. That's where I would tilt if it's a binary choice.
You know what, Shridatta, what's a great business for television? Commercials. We'll take a break, come back and chat some more with Shridatta Bhandwaldar. And welcome back to Wizards of the Street. I'm still with Ace Fund Manager Shridatta Bhandwaldar of Canara Robeco Mutual Fund. Shridatta, we talked about lots of things in our previous segment. Let me, if you were to summarize your investment philosophy for me, because you operate a lot of public money, what would that investment philosophy be?
So investment philosophy in a single line is very simple. That you focus on the underlying businesses and companies and forget about the stock tickers on a daily basis or in near term, because the market can remain far more irrational in near term, but it is very, very rational as you extend the timelines. So
it's a weighing machine in the long run.
Yeah, so the only thing that is in control and where you can focus on is what is happening to the underlying business, both on the balance sheets and on the earning side. So you be focused there. So that's the core philosophy for us as a house, apart from just me as a fund manager.
But let me ask you a question. A lot of fund managers will say that, of course, but markets are driven by extremes, as you well know. How do you have the patience to sit through when the market is, in your opinion, behaving irrationally?
I think, given your philosophy, you have very limited choices there. You go back to your basic default setting and say, am I actually not reacting to change in facts? So am I wrong, or is market wrong, or generally the masses are wrong? That's the decision you have to make. So every time you go back and test whether the earnings are going to play out, whether capital efficiency is going to play out, am I denying it just because it is happening in sectors or companies which you are not very comfortable with in the past, at least. And it happens time to time also, that it's not as if always the market is right, wrong and you are right. Equal number of time you are also wrong in terms of judging the changes that are happening. So you have to go back and actually test the hypothesis on facts and nothing else.
And then have the courage to sit through that.
And the courage to sit through it, which is the most difficult part, because most of your stakeholders who are not necessarily on the same plane would find it difficult. what is happening in market and what you are doing. So
But sometimes you get fired for underperformance, right? So is that a burden?
it is a burden, I think, for all the institutional fund managers. That's a pressure you have to live with. But I think over a period of time, what I realized is that if the only way any style or any fund manager outperforms is by sticking to what his basic tenets are, because there will be periods, time to time, where you will underperform. You can't have outperformance every year. So once you actually settle that in mind, then you can go back and focus on what you are good at, which is for us, which is selection. How can we get the selection of earnings right as many times as possible?
You know, you've obviously run through multiple stocks in your career in Canara Bank and the other places. Give me an example of what has been, you think, your best pick or your worst pick.
Okay, I'll say what has worked, what has not worked.
And I understand this is just not a recommendation, you're doing it for educational purposes.
So I think, and I'll actually largely stick to my current tenure at Canara Robeco, because then it will be relatively easy. Minda Industries, which is now called as Uno Minda, has been one of our best pick. It's almost more than a 10-bagger for us in last 7 years. And why we bought it was the change in facts, both in terms of how the management was actually moving in terms of their business strategies, and more importantly, how initially the promoter decided to actually move all his JVs and businesses which were in promoter group into listed entity at book value.
At book value,
which is very, very rare.
They're in the auto ancillary business?
They are in the auto ancillary business. They are among the largest auto ancillary players now, about 10,000 crore.
So you got the earnings cycle getting better?
We saw that basically earnings are getting consolidated at the group level.
Corporate governance
was improving significantly. And they were adding actually business segments which were aiding the growth. So both basically P&L expansion as well as the balance sheet cleaning up in a way.
And you had the courage to hold it till it became 10 bag or 15 bag or whatever it is?
We still hold it. So recommendation, this is not a recommendation to buy or sell. Disclaimer from our side.
Right.
Please consult your advisors before actually thinking you are of buying or selling this stock. So this is just just for explanation.
So Minda was a great example. Give me something that went wrong, because we all get it wrong.
I typically tend to remember them more, so I can give you several examples. So the first, I started actually my initial investments with non-ferrous. It looked like a great investment between 5 and 7, and I think that stock became 1/4 or 1/5 by 2010. So that's where I started. So mistakes are more clearly. Then in 2012-13, actually with my previous organization, I was holding few print media companies, and on basic principles they always looked good. You had 15% earnings growth, 17-18% ROEs, ROCs.
But a terminal business.
Wrong. Exactly. So it took me 2-3 years to realize that basically, or probably more, to realize that basically the terminal valuation is a challenge. So terminal value of the business is becoming 0. So it took more than 2 years, and basically stocks becoming half for me to learn that. So that's second.
What they call value traps in the business.
They call it value traps.
Correct.
Yeah, and then probably third would be, which I was discussing earlier also with you, was this explosive company, where for intermittent earnings challenges, we sold it off, and then it became 3-bagger from there. And when we were holding, it was already 5-bagger for us. If we had held it till date, it would have become 15-bagger effectively.
Of course, yeah. So a lot of people say that India is an idea whose time has come, the great bull market unfolding. How do you sense the next few years for India?
I think clearly time for India has come, and it would be it is of course reflective in all the parameters that you look at, be it demographics, be it the per capita where we have come, be it the advantages of democratic setup which are in place. I think rarely there are emerging markets where you have such good democratic setup as well as judiciary system.
Democratic and demographic setup.
And demographics plus judiciary system.
And a stable political system
and
now.
A stable political system,
So
which is likely to get extended now.
Could I force you to say we're in a new bull market in India?
I'm actually not a big fan of calling out markets because I feel that whether there has been bull market or bear market in India and you have been in market for a longer period than me, every year you have 20-30 opportunities in market.
Pick the stocks.
So pick the stocks. So
which
it's
is
a stock
what you
pickers
do.
market. Yeah, that's where I would encourage people to focus on.
Not focus on markets,
rather than
focus
getting,
bottom up. Right.
Bottom up.
Good point. You know, what I'm going to focus on next is what we call a rapid fire round, Shridatta. So we're going to have some fun with you. Value investing or growth investing?
I think blend.
Blend, okay. Active investing in the long run will always beat passive investing. True or false?
True, I believe that.
Okay, you won't be a fun match otherwise.
No, I must explain this because I feel that passive investments, not because we as a house don't do it, but fundamentally capitalism actually came in place to allocate capital efficiently.
Right.
Passive investment is like socializing capitalism.
Right.
So at some point in time it has to falter.
FIFA game or an IPL game? What would you rather watch?
FIFA game.
Okay, you're a football fan. The best book that you've read on investing?
So there are a lot of complex books that I have read, but I would rather stick to something that a lot of the viewers can actually read and get it very easily.
Sure.
That would be a little book that
the little book that beats the market.
Wealth by Pat Dorsey.
Yeah.
Which talks about moats and capital efficiency and compounding.
Good choice. A newspaper that you always read?
I read all editorials of all newspapers.
Name one.
I have to stick to Business Standard.
Okay. Who would you rather have a drink with? Tom Friedman from the New York Times or Peter Drucker?
Tom Friedman, I guess.
Okay. If you could invite any three investment professionals to your home for dinner, who would they be? Dead or alive?
It will be Warren Buffett, Charlie Munger, and to balance these two guys, you will have Seth Klarman.
Oh, lovely. All three great value investors. The Indian promoter that you admire the most?
I think Tata's, because although there is no single person, but as a conglomerate, they're the ones who have showed that you can create wealth
legitimately and for long periods
with
of time.
Values and integrity.
And great corporate governance, of course. If I give you this sentence, the next decade belongs to this, either say country, company or sector, what would you say?
I think India.
Okay.
Clearly, because there is fundamentally logical reason is growth differential of India vis-a-vis the rest of the world.
Also that we happen to be in India, that helps, huh?
That always helps. And I think in terms of sectors, it will be both consumer discretionary and the manufacturing value chain.
All right. If I'm just 30 years old in India, which India is a young country, I'm just 30 years old, what percentage of my savings would you say I should expose to equities?
If you have leverage, just get rid of that leverage. That's the first. If you don't have leverage, I think 50% at least should go into equities.
Equities, okay. You're going to encourage your dad and your brothers to get into equities, right?
I have tried that and failed.
Okay. What is the most popular app you have on your phone that you use all the time?
WhatsApp.
WhatsApp,
Yeah.
okay. Good enough. You know, Shridatta, in conclusion, author Robert Louis Stevenson said, I always kept two books in my pocket, one to read, one to write in. Thank you for sharing your thoughts with me today.
Thank you so much for having us on your show.
We'll see you on another episode of Wizards of the Street. Thank you for joining us.